This channel is for educational purposes only. Please do your own due diligence before making any investment decisions.
Hi, this is Joe Rabil with Invest Like a Pro. And so the question I have is, have you had a stock that you were in that you knew had earnings coming and you didn't have that great of a profit in it? It was kind of like not that far away from your entry, but it was acting well and looked good. Or a stock that you really wanted to buy that you knew had earnings coming in the next week. I want to give you an alternative because most of the time I just say, you know what, you want to stay away from that. But I'm going to give you a strategy that you could use using puts that can provide you with a cushion that will prevent you from taking any tremendous losses or huge losses, greater losses than you're expecting. So let's go ahead and get into this. But first, let me just say, if you have an interest in learning more about my strategy, go to rabilstockresearch.com/book. You can find information. I'm offering the book at a discount right now through as an ebook. It'll go through the strategy I'm going to show you today in depth. This is basically right out of my book. So let's go ahead and get into this. So I've got this TW, TradeWeb's Markets. Now, this is a stock that I was highlighting in my reports for my subscribers. And let me just show you why. All right. We had huge. So we'll just start with the monthly chart. And I'm going to show you why on the monthly, I viewed this more as a weekly daily trade. We had a move with a huge green bar here. And then we got a little minor pause with a red bar that pulled back. But we didn't form any kind of a pinch. We found really good support, though, at 80, and it looked to me like we could have a move back up towards this resistance zone up here. So I don't know that I would consider this a setup on the monthly chart, but this chart isn't preventing me from taking a trade. All right, that's the key. If I look at the upper time frame like this, and it just looks like there's no chance it can go up, then I don't really want to do a trade even on the smaller time frames. But as we start to look, you can see it's very obvious on this pullback here that we have three beautiful little red bars pulling in, pretty orderly. We've got a pinch play that develops. We've got strong ADX. This is the pattern we want. New high in price, right? We get a new high in MACD, new high in DI and ADX, and then you get your pullback to the 18, which is above the 40. Both lines are rising at about the same rate. I mean, this is the pattern we want to look for. Now, we know it's obviously a setup on the weekly chart. You look up a time frame just to make sure you're not, I basically call it not doing anything stupid, right? I mean, we don't want to get long this trade if on this time frame we've got an 18 like that, right? Or there's a massive amount of resistance right above, like if we've got all kinds of problems from historically speaking in an area, and you know, let's say you're doing it at, like we've topped at 100 4 times over the last couple of years, and you're doing the trade at say 91, or 94, I should say, then that's not really a great situation. I'd probably pass. But in this case, we were in the low 80s, all right, and we had some resistance up at 100, but that's 20% away. So the question becomes, can I get this trade going? So if you look at the way this played out, we get the pullback, it makes a move up, and it actually makes a nice little higher low here. And so let's just look at this. So we get a move to the upside, and during that phase, we had some overrun here. So I'm not going to just take a cross of the 40 on the daily chart. I'm looking for the second entry, which is right here. So we know if we do that, we've got earnings coming in about 3 trading days. Okay, so do I want to take this trade? Well, in most cases, I typically tell guys, you know what, just pass. All right, but I want to give you a choice if you want to do trades like this. And I'm going to give you an example of what I did. So I'm in this stock. I bought the 75 puts. Okay, my stop is right around 76 because the way I designed this trade, I used weekly risk and I'm taking daily targets, meaning I'm taking quick targets. I'm going to take a target at 1, 2, 3. All right. This way, what that allows me to do is it's giving me the ability. So I'm in this trade. I've taken one target. All right. But if I were doing this off the weekly, I would have taken one target, but my stop would not have moved. But because I'm managing it the way I would a daily trade, I'm using the risk off the ATR on this time frame. But what I'm doing is moving it to a break even right away after hitting the first target. So I take a quarter off and I go to a break even. Now, what this allows me to do is participate, because I know I've probably got some problems up here. Now, we make another move. Let's say I get the second target here, all right? And then we get up to 100. For all I know, it's going to fail and come back down. But what I'm going to do is, if I get to the second target, I'm going to raise my stop to the first target, all right? So if I get to 2, I'm going to put it at the first. You see what I mean? So I think that's how you want to handle a position like this that has some potential more than maybe just a quick run to the upside, because it does have a rising 18-month. It has the potential to move up, and it's been trading really well versus its peers. So we've got that. All right. I wanted to make sure I covered that. But let's just say you want to own this and you want to buy it before earnings. Well, what I'm doing is, here's my stop. My stop's around 75, something like that, 75, 76. So I buy the 75 puts for November 17th. All right. They're November 7th. They give me till the 17th of November. All right. I can see the trade through and then see how it reacts. And if I don't get stopped out, I can try and get whatever money I get back. So I paid 50 cents for those. Okay, I paid 50 cents. And what you do is if you have 500 shares, then you need to own 5 of these. Okay, because you want to protect, you have to buy 1 for every 100 shares that you own. Okay, so if you do that, then when it opens, if it doesn't look like it's going to crash. Now, here's the beauty of this. So let's say it opens up at 65. Okay. You know that you can get 75 because that's where you can exercise the put and you can sell your stock at 75. You're guaranteed to get 75 plus what you paid for the put. See what I mean? So you got to decide whether you want, how much do you really want to participate in this move? How much do you want to pay? I like to try and keep it low if I can keep it really cheap. But what this allows me to do is see the trade and know that even if it comes out and gets crushed, it just absolutely gets murdered. You know, I know I'm only going to lose my stop plus what I paid for the put. All right. Now, if it opens up down here, let's say it's 77 and it starts to turn up, you probably can get something for you paid 50 cents. Maybe you can get a little bit more. I think we ended up getting around like 14 or 15 cents, something like that for them. So in reality, I paid 35 bucks per contract. All right. To see the earnings. And to me, that was worth it. It was worth it to go ahead and give it a look. All right. Now, I don't do that every time. The pattern's got to look really high quality for me to want to do it this way. But I think it's a worthwhile approach in certain cases. And I wanted to offer this because I don't know if anyone's thought about it. But if you think, if you can put it in these terms. So here's the other thing that can happen. Let's say this opens up at 77 and then it just gets worse. Well, what you can do, and what I've done numerous times in the past, is the option is trading, and it's actually starting to pay you because you got the 75s. Remember, you bought it out of the money and then it turned into the money, and they're going to kind of show some decent strength. Now, you're not going to make the same amount that you did in terms of how much you lost in the stock. It won't be 1-to-1, but instead of losing a full, 1R full risk, a lot of times you lose like 0.5. Okay. So it can play out that way. And I've seen that happen as well, where it opens up here and then comes down and stops you out. And then you're making some money in the option, but not quite as much as you made. Where it really pays is if it gets murdered. Like if it really gets murdered, you're going to make, you might make more money in the option than you lost in the stock. Well, that's not true, because in most cases you will end up exercising. But there have been times where I've gotten an open here, and the option's actually giving me more than what I lost in the stock. So anyway, I wanted to give this out as a potential opportunity for you to play during earnings season, because a lot of times you can end up just standing aside. A lot of good-looking trades look like this right before their earnings, and you end up just passing. So it's a thought. It's something to think about if you're interested in doing that. It's a little bit higher risk. You're taking on a little bit more risk in the trade because you got to put money into the option. But it does give you the ability, especially if you're trading monthly, weekly trades, right? And if you have the same scenario in a monthly, weekly, and you want to be in it for a long time, this is where I really started using this strategy, and then started to look at it more and more. But I only do it if I've got weekly risk. If I'm using the weekly for my trade risk, all right? I don't typically do it on weekly, daily trades. And the reason is that it's hard to protect, and the options are a lot more expensive. So if you're doing it off the daily, your stop's going to be like right here or something like that, and you're going to have to pay a lot of money for the option. And to me, it's just not worth it. So I like to do it where I've got weekly risk, but I want to see the bigger picture pattern continue to move higher. And it's allowed me to stay in stocks that, could be going up for, say, a year and a half, something like that, when otherwise I'd have to just jump out. All right. Let me know if you have any questions, and we'll see you next time.